Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing world of business filings. Today we're looking at MicroStrategy, and let's just say they've got some interesting legal news that might make you scratch your head. So what's the big deal? MicroStrategy, a company you might know for its big bets on Bitcoin, has just filed this report, a Form 8K. Think of an 8K as a heads up to investors about significant events happening at a company that aren't part of their regular financial reports. This particular filing is all about a lawsuit that was just slapped on them, and it's not just any lawsuit, it's a class action, meaning a whole group of people who own MicroStrategy stock are suing the company and its board of directors. What are they suing about? Well, it's related to a particular type of stock MicroStrategy has called preferred stock. You can think of preferred stock as a bit different from regular common stock, like the kind most people own, like common stock here symbolized by MSTR. MicroStrategy also has these other kinds of stock, like the 18A0 Besho Series A perpetual stripe. Preferred stock, symbol XTs under the symbol STR, and another one called the 10.00 perpetual strife. Preferred stock, which trades under the symbol STR, and another one called the 10.00 perpetual strife preferred stock, which trades under the symbol STR and its PR, and another one called the 10.000 perpetual strife preferred stock, which trades under the symbol STR, and another one called the 10.000 perpetual stripe preferred stock, FING stock, which trades under the symbol STR, and another one called the 10.00. The lawsuit filed on July 21st, 2025 claims that MicroStrategy and its board broke a rule in Delaware where the company is incorporated. This Delaware rule, specifically Section 242, is about how changes to a company's foundational documents, like the ones that describe their preferred stock, need to be handled. The lawsuit argues that the shareholders of the regular common stock, people like you and me, if we owned MicroStrategy stock, should have been allowed to vote on a change made to the preferred stock. This change was to the terms of that preferred stock, the STR stock we mentioned. Essentially, the changes were made so that the preferred stock's value, or how much it's worth when you convert it or sell it, would be closer to its actual market price. The lawsuit says this change was a big deal and required a shareholder vote, which didn't happen for the common stockholders. So what do these suing shareholders want? They want the court to declare that MicroStrategy messed up, that the board breached their duty, and that the change to the preferred stock is basically void, like it never happened. On top of that, they're asking for damages, which means money to cover their legal costs and anything else they feel they lost. Now, MicroStrategy itself says they can't really say yet what might happen with this lawsuit, or if it will cost them anything. That's pretty standard legal talk when a company is responding to a new legal challenge. No one knows for sure how these things will play out. Looking at the company's stock registrations, we see here that their common stock, the MSTR, is listed on the NASDAQ Global Select Market. Their preferred stocks too, like the STR Clay, STR CSR, and STRD, are all on that same exchange. This shows they're a publicly traded company with serious financial instruments out there. The report is signed by W. Ming Shao, who is the Executive Vice President and General Counsel. This is the person within the company responsible for legal matters, so it makes sense for him to sign off on a filing about a lawsuit. Now, while this filing doesn't contain detailed financial tables of profit and loss, which would usually be in a quarterly or annual report, this legal action is critical. It highlights a potential governance issue. When a company makes changes to its capital structure, especially changes that could affect different classes of shareholders differently, that's a big deal. A company's board has a duty to act in the best interest of all shareholders, and lawsuits like this claim that duty wasn't met for MicroStrategy, whose strategy has been very public and aggressive, especially with its Bitcoin holdings. Any internal governance or legal clouds can cast a shadow over investor confidence. We've seen how sensitive the market can be to anything that might disrupt their core strategy or cash flow. So what's the takeaway here? This lawsuit is essentially questioning how MicroStrategy managed a change to its preferred stock. It's a reminder that even companies with a clear public strategy like MicroStrategy's focus on Bitcoin still have to navigate the complex rules of corporate law. The worry for investors isn't just about the Bitcoin price, but also about the fundamentals of how the company is run. A breach of fiduciary duty claim, if proven, can shake investor trust, and that's often more damaging than a short-term market dip. The company's success relies not only on its digital asset strategy, but also on its ability to maintain strong corporate governance. Weaknesses in this area can create significant risks, potentially impacting its stock price and its ability to maintain strong corporate governance. Weaknesses in this area can create significant risks, potentially impacting its stock price and its ability to raise capital in the future. It's a classic case of needing to walk the walk, not just talk the talk when it comes to legal and ethical corporate behavior. Alright, that's our quick decode of MicroStrategy's latest filing. What's your take on this lawsuit and what it means for the company's future? Let us know in the comments below. If you found this breakdown helpful, please give it a thumbs up and subscribe for more insights into the world of corporate finance and law. And don't forget to join our Discord community for even more discussions and direct access to us. We'll see you in the next decode.